After studying this module, you will be able to describe the adoption of IFRS in Indian context, know the recent developments in India to achieve convergence with IFRS, evaluate the costs and benefits of convergence of Indian accounting standards with IFRS, understand the differences between accounting standards in India and IFRS, identify the challenges faced by India in adopting IFRS, and suggest measures for proper implementation of IFRS in India. International Financial Reporting Standards, commonly known as IFRS, is a set of high quality, understandable, enforceable and globally accepted principle-based accounting standards for the preparation of financial statements. The International Accounting Standards Board (IASB), an independent standard setting body of the IFRS Foundation, is responsible for the development and publication of IFRS by following a thorough, open and transparent due process in close consultation with stakeholders around the world. The International Accounting Standards Board was set up in the year 2001 to replace the former standard setting body, the International Accounting Standards Committee (IASC). The use of IFRS as a universal financial reporting language is gaining momentum across the globe. More than 100 countries, such as those from Australia, European Union, Russia, etc., now require or allow use of or have decided to adopt IFRS, and the number is expected to increase further in the coming years. There are two alternative ways available to a country to comply with IFRS. Number one, adopting of International Financial Reporting Standards in its original form, or number two, adoption or convergence with International Financial Reporting Standards. Keeping in view the advantages of implementing IFRS for the Indian economy, investors, industry and accounting profession, the Accounting Standards Board (ASB) of India, in consultation with the Council of Institute of Chartered Accountants of India, decided to follow convergence path. In general, convergence means to harmonize and maintain uniformity with international financial reporting standards. However, the IASB clarifies that adding disclosure requirements or removing optional treatment as per local environment conditions does not lead to non-compliance with international financial reporting standards. Thus, in Indian context, convergence with IFRS means adoption of international financial reporting standards with necessary modifications to reflect Indian conditions. Let us now discuss the accounting standards in India. In India, the accounting standards are formulated by the Council of ICAI through its Accounting Standards Board (ASB), which was formed in the year 1977 in the month of April. Thereafter, the National Advisory Committee on Accounting Standards (NACAS), constituted under Section 210A through Companies Amendments Act 1999, reviews those standards and recommends them to the central government. The government then considers the recommendations of NACAS and on accepting them notifies the standards under the Indian Companies Act 1956 by publishing them in the official gazette. Initially, the accounting standards were only recommendatory in nature, but after insertion of section 211, subsection 3C by the Companies Amendment Act 1999, compliance was notified. Accounting standards have now become mandatory. At present, 31 accounting standards have been issued by the Institute of Chartered Accountants of India, out of which 28 standards, with a few exceptions, have been made mandatory. While 3 standards are not mandatory, they are still recommendatory in nature. Convergence with IFRS in India. In the year 2007, the ASB finalized the concept paper on convergence with IFRS in India after considering the suggestions of the Council of ICAI and commenced the process of developing a complete new set of accounting standards that are based on and converged with IFRS, referred to as Indian Accounting Standards. The Indian accounting standards are allowed to depart from IFRS to account for differences in cultural, legal, political and economic environmental conditions. As part of convergence strategy, the ICAI has classified IFRS into 4 categories. Category 1, International Financial Reporting Standards, which can be adopted immediately or in near future as they have no or minor differences with the corresponding Indian accounting standards. For example, construction contracts, borrowing contracts, inventories, cash flow statements, etc. Category 2, International Financial Reporting Standards, which may require some time to reach a level of technical preparedness by the industry and professionals, keeping in view the existing economic environment and other factors such as investment, property, share-based payment, etc. Category 3, International Financial Reporting Standards having conceptual difference with the corresponding Indian accounting standards that should be discussed with the IASB, for example, investments in associates, joint ventures, provisions and contingent liabilities. Category 4, International Financial Reporting Standards, the adoption of which would require amendments in laws, regulations such as accounting policies, property, plant and equipment, first time adoption of International Financial Reporting Standards. In pursuance of commitment given by India in G20 summit held in Pittsburgh in September 2009, 35 Indian accounting standards converged with IFRS were notified by the Ministry of Corporate Affairs and placed on the website of MCA in February 2011. The Indian accounting standards were supposed to come into force on 1st April 2011. However, these could not be implemented as per proposed timeline due to various reasons have not been notified under the Companies Act till date. Recent developments in India to achieve convergence. In a move to converge with IFRS, certain provisions have been incorporated in the new Companies Act 2013, which came into force in September 2013. As per section 129, subsection 3 of the Act mandates consolidated financial statements for any company having a subsidiary, associate or a joint venture. The Act has also given cognizance to the Indian accounting standards converged with IFRS, considering their applicability in future. For instance, statement of changes in equity required under Indian accounting standard has been included in the definition of financial statements under the new Act. The new Act also provides for valuation by registered valuers to facilitate computation of fair value. Moreover, the MCA has notified and made applicable revised Schedule 6 from 1st April 2011. It is compatible with IFRS and only allows presentation of balance sheet and profit and loss account in vertical format and eliminates the option of horizontal format or T-form. The grouping of assets and liabilities has been made as current and non-current. Furthermore, the Securities and Exchange Board of India, known as SEBI, Wide Circular dated April 5, 2010, has given an option to listed entities having subsidiaries to prepare their consolidated financial statements either in conformity with the existing accounting standards notified under Companies Act 1956 or IFRS issued by IASB. However, only few companies have exercised this IFRS option. On January 22, 2010 and March 31, 2010, the MCA issued press release laying down the roadmap for IFRS convergence in India. The roadmap requires converged Indian accounting standards to be applied in a phased manner by all banking companies, scheduled commercial banks and urban cooperative banks, non-banking financial companies, insurance companies and other companies. The various phases and respective timelines for convergence. However, the aforesaid roadmaps issued by the MCA could not be implemented from 1st April 2011 and the date has been deferred due to certain unresolved matters primarily involving tax-related, regulatory, legal and economic issues. A revised roadmap for adoption of Indian accounting standards converged with IFRS has been proposed by Council of the Institute of Chartered Accountants of India at its meeting held in March 2014 and has been submitted to the MCA for its consideration to take final decision on its implementation. The recommendations under revised roadmap released by ICAI are: Number 1. There will be two separate sets of accounting standards under the Companies Act 1956. The first set would comprise the Indian accounting standard converged with the IFRS, which will be applicable for preparation of consolidated financial statements by specified companies. The second set would include the existing notified accounting standards, which will be applicable to other companies, including small and medium-sized companies. 2. The Indian accounting standards will be applied by the following specified classes of companies in preparing consolidated financial statements for accounting periods beginning on or after 1st April 2016 with comparatives for the year ending 31st March 2016 or thereafter. A. Entities with equity or debt securities listed or in process of listing in or outside India. B. Companies having a net worth of rupees 500 crores or more with a net worth calculated as per standalone audited balance sheet of companies as at 31st March 2014 or the first balance sheet after that date. C. Holding subsidiary, joint venture or associate companies of the above two classes of entities. 3. The other companies not specified above shall have the option to apply Indian accounting standards on an irrevocable voluntary basis. 4. The roadmap for banks, NBFCs and insurance companies will be decided in consultation with the Reserve Bank of India and Insurance Regulatory and Development Authority. In the budget speech of 2014-15, the Honorable Minister for Finance, Shri Arun Jaitley, has said that the converged Indian accounting standards will become mandatory from fiscal year 2016-17. However, they can be adopted by companies on voluntary basis from fiscal year 2015-16. The announcement is in line with the ICAI proposed roadmap. It is envisaged that this move will improve the quality of financial reporting in India and would attract foreign capital into the country. Let us now discuss the benefits of convergence with IFRS. The convergence with IFRS has various benefits for the Indian economy, investors, industry and accounting professionals, which are: Number 1. Convergence with IFRS increases the transparency and improves the level of understandability and comparability between the financial statements of companies across different countries. 2. Better market efficiency, increase in capital formation and greater economic growth for India. Number 3. More foreign capital flows to India and lower cost of raising funds from abroad. 4. More international business collaborations and joint ventures. 5. Lower cost of preparing financial statements. Number 6. Reduced standard setting costs for India. 7. More relevant, reliable, credible, timely, true and fair and comparable accounting information to investors and other stakeholders. Next, difficult for companies to commit accounting frauds like Enron and Satyam due to the principle-based standards in place of rule-based standards. Next, more opportunities and greater mobility for Indian accounting and auditing professionals to work in different parts of the world. Next, India can emerge as a major hub for offering accounting and auditing services. Moving on to the disadvantages of convergence with IFRS. Although convergence with IFRS has many benefits for the Indian economy and international business, it also has some disadvantages. There is lack of detail and limited guidance under IFRS since these are principle-based standards. Significant costs of adoption and implementation for standard setters. Additional short-term costs to companies such as heavy fee payable to specialists, IFRS accountants. Significant time and resources are required to be invested in re-education and training by companies and professional institutes like ICAI and ICSI, etc. There will be some inefficiencies. For instance, the cost of changing historical audited financial statements prepared as per old rules just for the sake of companies with IFRS based financial statements, resulting in extra cost to the company. In some cases, entities may be required to prepare different financial statements for local accounting and tax laws. Adoption of IFRS potentially creates uncertainty and stock price volatility. Global convergence with IFRS reduces competition amongst alternative financial reporting systems and hence reduces innovation. Lastly, there exists a risk of IASB becoming politicized, polarized and bureaucratic body in long term. Let us now understand the difference between IFRS and accounting standards in India. IFRS are more principle based and allow more flexibility to the preparer of financial statements, whereas Indian accounting standards in India are more rule based and rigid, not allowing much flexibility to the preparer. IFRS have been drafted in clear, simple and lucid manner. Indian GAAP and accounting standards are more complex, long and detailed. IFRS emphasize that companies should report the ascents of each small transaction based on economic substance rather than legal form. Indian accounting standards have been driven by the written contract and the form of transaction as opposed to the substance. Under investors' needs are given priority over law. Under Indian GAAP and AS, legal requirements get priority over investors' needs. Historical cost is used, but primarily IFRS emphasize on fair value, the intangible assets, property, plant and equipment and investment property may be revalued, while derivatives, biological assets and most securities must be revalued at fair value. In accounting standards, financial statements are prepared based on historical cost except for fixed assets other than intangible assets which may be revalued at fair value. Under IFRS, reporting is done in functional currency, which is the currency of the primary economic environment in which the entity operates and may differ from local currency. Under Indian GAAP and accounting standards, financial statements are required to be prepared in local currency only, that is Indian rupees. Under IFRS, depreciation is allocated over the useful life of asset, which has to be computed again and again until the asset is removed from the books of account. Under Indian GAAP and accounting standards, depreciation is based on higher estimate of useful life of the asset or the rates prescribed by the Companies Act. IFRS do not prescribe a particular format. However, certain items must be presented on face of the balance sheet. Under Indian GAAP and accounting standard, the revised Schedule 6 and other industry specific laws like banking, insurance, etc. specify respective formats. IFRS do not prescribe a particular format. However, certain items must be presented on the face of the income statement. Expense classification may be based on nature or function. Under Indian GAAP and accounting standards, the revised Schedule 6 prescribes vertical format and expenses to be classified only on the basis of nature of expense. Under IFRS, cash flow statement is mandatory for all entities. Under Indian GAAP and accounting standards, cash flow statement is mandatory only for entities specified by the ICAI. Under IFRS, statement of comprehensive income is prescribed and is a component of financial statements. Under Indian GAAP and accounting standards, the statement of comprehensive income is not prescribed. Under IFRS, no transaction can be termed as extraordinary or exceptional since all events are assumed to be in the normal course of business. Under Indian GAAP and accounting standards, extraordinary items are required to be presented in the profit and loss statement of the entity. Under IFRS, changes in depreciation method is treated as a change in the accounting estimate and hence is accounted for prospectively. Under Indian GAAP and accounting standard, change in depreciation method is treated as a change in the accounting policy and is accounted for retrospectively. Under IFRS, dividends declared after the balance sheet date but before the financial statements are approved are not recognized as liability on the balance sheet date. Under Indian accounting standards, dividends declared after the balance sheet date but before financial statements are approved are recorded as liability. Under IFRS, redeemable preference shares are treated as liabilities. Under Indian GAAP and accounting standards, redeemable preference shares are part of share capital. Under IFRS, convertible debt is treated as part of equity share capital and is not repayable after a certain period of time. Under Indian GAAP and accounting standards, convertible debt is recognized as a liability based on legal form. Under IFRS, both the financial assets and financial liabilities are valued at fair value to compute NAV. Under Indian GAAP and accounting standards, the financial assets are valued at market value while the financial liabilities are valued at historical cost to compute NAV. Under IFRS, preliminary expenses are charged to income statements. Under Indian GAAP and accounting standards, preliminary expenses are treated as deferred revenue expenses and written off over a period of 5 years. IFRS do not require public entities to furnish interim financial reports. Under Indian GAAP and accounting standards, the listing agreement in India requires all listed companies to furnish interim quarterly financial results. Moving further, we shall now identify the challenges for India in adoption of IFRS. Adoption of IFRS in India is a difficult task and India has to face various challenges in its implementation, primarily due to differences that exist between IFRS and accounting standards in India. The major challenges before India are: number 1, there are differences in economic, social, legal and regulatory environment across countries. Number 2, there is a need to change several laws and regulations that govern financial reporting practices in India, for example, the Companies Act, Banking Regulation Act, RBI, SEBI and IDRA regulations, etc. Number 3, the application of fair value principle under IFRS would bring significant changes in presentation of financial information, resulting in subjectivity and volatility in reporting earnings, EPS and price earning ratios. Number 4, there is a lack of availability of actuarial professionals in India to determine reliable fair value. Number 5, there is a lack of clarity on tax implications of convergence with IFRS. Number 6, the High Court has the authority to prescribe accounting requirements in case of merger and acquisition situations. Number 7, management compensation, stock options, debt covenants, tax liability and distributable profits are all based on existing Indian GAAP or accounting standards and will have to be substantially revised. Number 8, India does not have adequate IFRS professionals having practical experience of convergence. Number 8, resistance towards change from politicians, industry and other stakeholders also pose great challenge. Next, there are apprehensions regarding IFRS, primarily due to application of fair value, popularly known as mark-to-market accounting, which was used as a tool for manipulation in infamous Enron scandal. Next, the IFRS transition cost to be borne by Indian enterprises is huge. Lastly, other challenges include education and training requirements, inadequate infrastructure, shortage of resources, improper information system and IT applications, etc. There is a dire need to put in place a proper mechanism for effective implementation of IFRS. Suggestions should be considered by Indian regulatory and professional bodies and by the industry at large to ensure smooth implementation of IFRS in India. Such suggestions may include education and training, the investors, financial analysts, stakeholders, teachers, accountants, auditors, tax professionals, etc. all need to be educated and trained. IFRS should be introduced as a full-fledged subject in universities, especially in chartered accountancy curriculum. The ICAI has already launched certificate courses and e-learning courses on IFRS. Also, in collaboration with the MCA, the ICAI has started a large-scale IFRS awareness drive and has conducted several workshops, seminars and conferences on IFRS in various parts of the country. Amendments in existing laws. The existing laws should be timely and suitably amended to make them consistent with IFRS. Tax clarification. The tax authorities in India should issue clarifications on tax treatment of items arising on account of convergence with IFRS. Adequate infrastructure. The Indian firms should build required infrastructure to ensure smooth and hassle-free transition to IFRS. Coordination. All the interested parties, including regulators, top management investors, accounting and tax professionals, and other stakeholders should work together as a team to accomplish this challenging task of convergence. Disciplinary action. The proposed roadmaps and timeliness should be strictly followed and disciplinary action should be taken in case of non-observance and default. The RBI and IDRA should also give clarification on adoption of IFRS for banking and insurance companies. The representation on IASB should be more diverse and political pressures on it should be avoided so as to be fair to all the countries around the world. Let us now summarize what we have learnt in this module. From the above discussion on convergence of Indian accounting standards with the IFRS, it is clear that convergence with IFRS has many advantages for India and global economy with some disadvantages. However, the benefits of adopting IFRS are expected to outweigh the costs. Also, the recent developments in India like New Companies Act 2013, Revised Schedule 6, new proposed roadmap by ICAI, announcement in 2014-15 budget, etc. clearly indicate India's intention and commitment to adopt IFRS. Despite various challenges faced by lawmakers, regulatory, industry and accounting professionals, India has been slowly and steadily progressing in the process of convergence. The smooth and speedy transition to IFRS requires India to have adequate infrastructure sufficient number of educated and trained professionals, and proper coordination among the various interested groups involved in the convergence process. Since the convergence process in India and other parts of the world is still going on, we cannot precisely state the impact of adopting global accounting standards. The actual implication can be unveiled only once the converged Indian accounting standards are practically applied and experienced by India.